What does it take to make £1 million every single day? In 2020, one man paid himself £343 million. That's more than any single person in British history. 2 years later, he took home a dividend of nearly $700 million. This isn't the story of a lottery winner. This is the story of a predator, a paradox. This is the story of Sir Christopher Hohn. In 2025, his hedge fund, TCI, didn't just beat the market. It shattered records, generating an almost unbelievable $18.9 billion in profit for its investors in a single year. He operates from a small, secretive office in London with a team of just 7 or 8 people, managing over $77 billion. He's been called a locust, an unbelievable, arrogant loner, and Europe's most feared investor. He's also been knighted by the Queen for giving away billions to charity. To understand how one man can embody such contradictions, how he built a money-making machine that rewrote the rules of investing, you have to go back to the beginning, to a place far from the glittering towers of finance. Christopher Anthony Hohn was born in 1966 in Addlestone, Surrey, a world away from Wall Street. His father was a Jamaican-born car mechanic who had moved to Britain in 1960. His mother, a legal secretary. In his own words, his family was poor. This background forged a mindset. Hohn would later say, "It made me an independent thinker, growing up as an outsider and feeling different. It gave me a work ethic and a desire to achieve something. That desire first pointed towards medicine, but a squeamishness at the sight of blood put an end to that dream. So he turned to business. He enrolled in the University of Southampton, graduating with a first-class degree in accounting and business economics. It was there that his life took a decisive turn. A professor, a Harvard MBA himself, saw a spark in the driven young man and urged him to apply to the most prestigious business school in the world. He didn't just get in. In 1993, Chris Hohn graduated from Harvard Business School as a Baker Scholar, an honor reserved for the top 5% of the class. Get free access to our online trading course in the description and in the pinned comments. If you want to learn more about ETFs, more about the foreign exchange market, and more about basic financial literacy, then this is a must for you. Be sure to download it. After a stint in private equity, he joined the hedge fund Perry Capital in New York. The story goes that founder Richard Perry wanted to hire him but had no desk space. Hohn's reply, "I can bring my own desk." He was hired on the spot. By 1998, he was running Perry's London office, and by the early 2000s, his European fund was generating over 20% a year, finding what he called a candy store of fantastic opportunities. But Hohn was restless. He was frustrated with the traditional hedge fund model of playing it safe. He wanted to be concentrated. He wanted to be aggressive. He wanted to build his own house by his own rules. And in 2003, he did just that. When Chris Hohn launched the Children's Investment Fund, or TCI, in 2004, it was unlike any other hedge fund. He built a charity into its very DNA. A fixed portion of the fund's fees would automatically go to the Children's Investment Fund Foundation, a charity run by his then wife, Jamie Cooper. He later admitted the public charity was his wife's idea. He worried it would deter investors, but the structure was also a promise to himself, a commitment made years earlier as a 20-year-old in the Philippines, witnessing extreme poverty for the first time. Hohn said, "At that moment, I made a commitment. If I ever had the resources, I would work to address the barriers that prevented children from living healthy, happy lives."
I give away everything I earn. I don't really care about money for other than its value in helping people.
When did you learn about philanthropy? Who taught you?
When I was in New York working for a hedge fund, at one point after about 3 or 4 years, it made, I don't know, $2 or $3 million, and they had done well, and they said, you're going to get a $10 million bonus. And I just, this is in intuition, said I don't want it. I want to just give it to charity, and I created a US foundation and gave it to it.
His first major target, Deutsche Börse, the German stock exchange. In late 2004, the Deutsche Börse announced its intention to buy its London rival. Hohn, as shareholder, was furious. He believed the deal was terrible for investors. But what could a small upstart fund do against one of the giants of European finance? This was the moment the world discovered Chris Hohn's playbook. He didn't just complain. He organized, he agitated, he waged a relentless public and private campaign against the deal. He demanded the resignation of the CEO, and he rallied other shareholders.
Deutsche Börse, starting with that, they had a derivative business called Eurex, which was a natural monopoly. It was a network effect. This was the barrier to entry. That liquidity of a marketplace for trading bond futures, European bond futures, the network effect of getting best prices in the most liquid market meant it became what is termed a winner takes all, or natural monopoly.
Yeah.
And once you have that liquidity, very hard to move people away. Price, you can never compete on best price.
In March 2005, the unthinkable happened. Deutsche Börse buckled under the pressure and withdrew its bid. By May, the CEO was gone. Later, the chairman followed. The company's stock price skyrocketed, netting a massive profit for TCI. The defeated CEO would later write a book titled Invasion of the Locusts, calling Hohn an unbelievable, arrogant loner. He may have been arrogant, but he was also right, and he was also just getting started. In 2007, he took on the Dutch banking group ABN AMRO. With just a 1% stake, he forced the company to put itself up for sale, leading to a $100 billion takeover at the absolute peak of the market. TCI's profit, a cool $1 billion. He battled the US railroad CSX using a complex derivatives to build a massive hidden stake before launching a proxy fight and winning seats on the board. He took on corporate giants in Japan, France, and Canada. Chris Hohn wasn't just an investor. He was an activist, and he was feared. By 2008, Chris Hohn was the golden boy of activist investing. He had built a 19 billion empire in just 4 years, delivering staggering 40% annualized returns. He seemed invincible, but then the world broke. In the inferno of the global financial crisis, TCI was burned. The fund lost a devastating 43% in 2008. But then the real test came after the crash. As markets began a historic recovery in 2009, with the S&P 500 surging 26%, TCI was left behind, gaining only 10%. The following 2 years were just as disappointing. His investors, once loyal, fled in the droves. The fund's assets collapsed from a peak of $19 billion to less than $5 billion. Key analysts, the stars of his small team, walked out the door. The house that Hohn built was crumbling. This was Hohn's moment of truth, a period of intense, brutal self-reflection. He later admitted his mistakes with unflinching honesty.
What are the type of companies you would never invest in? Type of industries?
Yeah, that's a good question. We have a long list of companies we don't invest in. We're very focused, and we call them the risky and bad industries. And I have invested in some of these in the past, but I've learned.
Sure.
Banks, I remember pre-financial crisis, I had a look at Credit Suisse, and I sat down with the then CEO, Brady Dugan, and said, put his balance sheet in front of him from the annual accounts, and said, you have a multi-trillion dollar balance sheet. Can we walk through the line items? Because I don't understand it. He said, I don't either. And he was a very honest guy. I really liked him.
Very
He was
confident.
very honest. And
Okay, so
but
banks you don't do.
Get free access to our online trading course in the description and in the pinned comments. If you want to learn more about ETFs, more about the foreign exchange market, and more about basic financial literacy, then this is a must for you. Be sure to download it. We had strayed from being heavily invested in stocks with a high barrier to entry and a bulletproof franchise to weaker industries. Then we weren't fully invested in 2009. The team and the fund got too large. He realized his activism had led him into battles over bad businesses. His $1 billion win on ABN AMRO, he called it madness, admitting neither the bank nor TCI really knew what they were doing. It was a profound lesson. Fighting over scraps is a loser's game. The real money wasn't in fixing broken companies, it was in owning unbreakable ones. So Chris Hohn reinvented himself, and in doing so he created one of the most powerful investment philosophies of the modern era. The new playbook was simple, but ruthless in its discipline. No more chasing distressed assets, no more complex special situations. From now on, TCI would only invest in one thing: high quality, monopoly-like businesses.
one of the things we learned is, and there's a really important point, is that we can have an advantage through long-termism. Okay, which is the average stock is held by an institutional investor by under a year, or the stock market in the US.
How long do you hold it?
Our average holding period of our current portfolio is 8 years.
8 years.
Yeah, 8 years. I'm not saying that's the limit. It's just we've on average, some we've held for 13 years. Some new investments like GE Aerospace 2 years. But the average, weighted average holding period is 8 years.
From 2012 to 2025, TCI's performance was nothing short of breathtaking. He did it by owning the untouchables, the toll booths of the global economy. He bought Microsoft, he bought Visa, he bought Moody's, one of the twin titans of the credit rating industry.
Moody's,
A rating
agency. So it's been around 100 years. What do you think the average, I can ask you a question, make it fun. What do you think the average revenue growth over that 100 years has been?
I'm going to look like a total fool, but
100 years, long time.
7%.
10.
Wow.
He bought railroads, Canadian National and Canadian Pacific, the physical arteries of North American commerce, impossible to replicate. This wasn't about finding the next hot stock. It was about identifying businesses so dominant, so essential, that their future profits were almost a certainty.
Understanding the sustainability of business models, and taking a long-term horizon over which the persistence of high barriers to entry plays out, very much in the philosophy of Warren Buffett. Secondly, we have a deep sector expertise in some sectors, including infrastructure and consumer goods, which help us to understand when opportunities are good. Thirdly, we run concentrated. Positions can be in excess of 10% of NAV, and so by concentrating our capital in a handful of very good ideas, where we find the alpha, it can mean something and can outperform.
And then came 2025. His biggest bet was on a legacy of American industry, GE Aerospace. While others saw an old complex conglomerate, Hohn saw a crown jewel, a world-class monopoly in jet engines with an installed base that would generate service revenue for decades. He piled in, making it over a quarter of his entire fund.
The airline industry over 100 years has had a lot of growth. Airline travel has grown at 5% a year. Continues to grow consistently. But airlines as a business, cumulatively and collectively, have made almost minimal profits, despite growth, because of the very low barriers to entry. And so I would say growth without barriers to entry is not a combination that you want.
The bet paid off spectacularly. GE Aerospace stock surged 83% in 2025. Fueled by this and his other monopoly holdings, TCI delivered the single greatest one-year profit in hedge fund history, $18.9 billion. It was a masterclass in conviction investing, and the rewards were personal and astronomical. In the year to March 2020, he paid himself a dividend of $479 million, a record for any individual in the UK. In 2022, he took home another dividend of nearly $700 million. He became one of the wealthiest people on the planet, with a net worth north of $11 billion. But as the money poured in, the paradox of Chris Hohn only deepened. What do you do when you have more money than you could ever spend? For Chris Hohn, the answer was simple. You give it away. And you use your power to force change whether the world is ready or not. His charitable foundation, CIFF, became one of the largest and most influential in the world, with a $6 billion endowment. He was knighted in 2014 for his services to philanthropy. He signed the Giving Pledge, committing the majority of his immense wealth to charity. But Chris Hohn doesn't just write checks. He uses the same ferocious activist playbook that terrified boardrooms to now tackle the world's biggest problems. His new target, climate change. In 2020, he launched Say on Climate, a campaign to force the world's biggest corporations to disclose their emissions and present a credible plan to reduce them. He pressures companies in his own portfolio, and he's not afraid to vote against management if they don't comply. And in the ultimate paradox, the master of capitalism became the single biggest individual donor to the anti-capitalist environment group Extinction Rebellion. A man who has perfected the art of making money in the current system while simultaneously funding those who want to tear it down. So what is the lesson from the incredible story of Sir Christopher Hohn? How did the car mechanic's son build an $11 billion fortune and one of the most successful investment firms in history? His playbook is deceptively simple. First, find truly great businesses. Not good ones, not cheap ones, great ones. Businesses protected by impenetrable moats that can stand the test of time. Second, be concentrated. When you find a truly great idea, bet big. The average investor diversifies. Hohn's focuses at one point. He had over 22% of his fund in a single stock. Third, think long term. In a world obsessed with the next quarter, Hohn holds his positions for an average of 8 years. He lets the power of compounding do the heavy lifting. And finally, act like an owner. Don't be a passive shareholder. Engage, question, and when necessary, fight for the value you believe is there. Chris Hohn's story is a testament to the power of independent thought. He ignored the crowd, survived a near-fatal crash, and rebuilt his empire on a foundation of pure, disciplined conviction. He proves that in a world of trading and investing, you don't need a massive team or a complex strategy. You need a clear philosophy. You need the courage to be different, and you need the discipline to stick to your rules, especially when it's hardest. That is how you build a legacy, and that is how you become the £1 million a day day trader. If you've enjoyed this video, then make sure you hit like, subscribe, and get in the comments. And most importantly, in the description, you'll find our pinned free online education course. Get knowledgeable on the markets and get ahead of the crowd.